Well, we know it's earnings season, but believe it or not, the budget or the vote on account is also only 2 weeks away. And the first thing we need to know are the big, broad numbers in the budget. What GDP growth should the government assume? And hence, what kind of tax revenues it should assume? Normally, tax revenues grow as much as nominal GDP. What kind of deficit should the government go with? And therefore, if you deduct the tax revenues, if you deduct the deficit from the tax revenues, what is available for expenditure? Therefore, will we have another year of Gargantuan capital expenditure? For all those questions, I have with me two economists, Aditi Nayar of ICRA and Devendra Pant from India Ratings. We are beginning with the rating agencies, obviously because they are the only ones who rate the central government bonds and hence their estimates become important. So welcome, Aditi and Dr. Pant. Well, first, a little bit on this year's revised estimates, because next year will be built on this year's revised estimates. So, Aditi, what are the higher tax revenues you are assuming? It's very clear that this year we have done exceptionally well on tax collection, especially income tax.
Absolutely, Latha. So we're penciling in higher revenues on direct taxes, both income tax and corporate tax. Also, GST has been doing quite well, but there are some lags, particularly on the excise side. So that is something that is reducing the overall upside on the tax revenue side. And on non-tax revenues, we have a good amount of funds coming in from the the dividends and profits, but we will end up with a shortfall on disinvestment. So that side should broadly net itself off, and we will end up with a small upside on the net receipts to the center of about ₹500 billion or so.
Okay. Well, Dr. Pant, your estimates on tax collections, I think income tax is growing by some 37%. So have you upped the overall tax receipts for the current year? And what does that do to deficit, actually?
So, Latha, we expect the tax revenue, the net tax revenue to the center after netting out what goes to the states. We expect net tax revenues to be 1.2 trillion rupee more than the budget estimate. So we are looking at somewhere around 24.5 trillion rupee worth of tax revenue. The non-tax revenue we are expecting again higher than somewhere around 700 trillion rupee higher than what government had busted in. Now here is the situation. Because your deficit, disinvestment is the one which is pulling down your overall receipts and leading to a higher inflation, higher deficit. But if you look at how it is going to pan out, we expect the overall fiscal deficit to be marginally higher, or I say optically higher, but almost similar to what it was busted for. But since the as per NSO, the nominal GDP growth is going to be way too low compared to what was assumed in the budget, we expect classical case fiscal deficit almost similar to the budgeted in the value terms. But because of the lower GDP, we may see fiscal deficit somewhere around 6% of the GDP this year.
Okay.
Having said that,
there
are, since all of us know these accounts are created, are on cash basis, a couple of thousand crores here and there can again bring back these numbers to the 5.9% level.
So
won't be surprised if FM says on the 1st of February that we have achieved or have done better than 5.9. But we believe it will be 6.
That point is taken. Aditi, there is a possibility, of course, the FM may say we have achieved the 5.9 or will achieve the 5.9%. After all, CapEx is lower than expected, right? So that also will give them some money, and therefore she can go with 5.9?
So, Latha, we are right now saying 6. We think the absolute fiscal deficit target will definitely be met. And because of the nominal GDP being lower than budgeted, the upper end is that we will end up with a fiscal deficit of 6% of GDP. So on CapEx, particularly if you look at the months of October and November, we have a contraction in CapEx coming in through these 2 months after a very good performance in H1. And specifically, if you look at the state's CapEx loan scheme, Now, between what was approved so far for this year and what has actually been released, there is a gap of 40,000 crore. My sense is that since the states, there is a clause that the money taken under the scheme needs to be spent in this fiscal year itself. Otherwise, they will get docked the borrowing permission for next year. So I don't think states will be very keen to take on more money now unless they're very sure that the projects for which they're taking the money can be finished within this fiscal year itself. So I think this is another reason we're going to end up with some lower than budgeted capex. In any case, in the last few years, expenditure savings, which is budget plus supplementary less actuals, has been in the range of 1 to 2 trillion. So even if we assume it will be 1 trillion, then I think we're quite safe. We're going to end up with capex, which overall expenditure, which is broadly in line with the budgeted number. Only one thing, I do think we're going to end up with a second supplementary for food subsidy and for Narega. So I think there is still some more expenditure that is required under these two schemes after the first supplementary.
Okay.
But overall,
Which is
the
all the
fiscal deficit target doesn't look like it's under any threat.
Yeah, that's right, which is all the more reason why there is a possibility of a capex shortfall, especially from the states in the coming months. We must brace for that. Dr. Pant, therefore, what kind of a fiscal deficit assumption will we see in Budget 25?
Look, Latha, the government has made this paths like by FY26, we are going to have 4.5% of the GDP as the fiscal deficit. So there is a course correction of either 140 or 150 basis point, assuming 5.9 comes true, that 140 basis point. Now, 140 basis point, if you look at past 2.5 or 3 decades, in 2 years, that correction, 2 years, 140 basis point correction was done maybe around 8 times. Out of those 8 times, there were the 4 times when the initial or the base on which the correction is being made was an abnormal year and the fiscal deficit was high. So there are still 4 instances where the government was able to correct fiscal deficit or fiscal consolidation of 140 basis point or more in a span of 2 years. Now, if we look at now and so the FY 2025 will be more like slightly abnormal because from the expense side, you will not see much of new things getting taking up till the June. So we believe and we are coming out of a long phase of 6 or 7 months of high WPI negative growth, which is pulling down the growth of the nominal GDP. So we believe it will be somewhere around 5.3, and that will leave the heavy lifting of around 80 odd basis point next year.
So you're going with a nominal GDP of 10.5, Dr. Pant?
Yeah, 10.5.
Okay. Aditi, your nominal GDP forecast is lower at 9.5, and there are some people on the street who don't see a very high wholesale price index. So there could be perhaps an average of 10. Now, if that is the case, do you think they will announce a 5.3% fiscal deficit? Or, announce more like 5.4 or 5.5 and say that we will do more adjustment later? Is that a possibility?
The sense I have is it's harder to announce a bigger fiscal deficit target and prune it later. It may be more prudent to announce a sharper amount of fiscal consolidation upfront and hope for the best after that. So the way we worked out the numbers, we're looking at a 9.5% nominal GDP growth, and we're looking at an 11% growth in the gross tax revenues. And a very modest disinvestment target. There's no point putting out a target that the market starts questioning right from the get-go. On the expenditure
let me
side,
interrupt you. Let me interrupt
that,
you. Aditi, let me interrupt you. I'll tell you why. Why not a 5.4? Because this year the tax buoyancy is 1.4%. For the viewers, what it means is that if nominal GDP goes up by 100 rupees, the tax to GDP is going up by 140. Simply because more people are paying taxes is going to the amount of GDP is going to the tax-paying public, or tax collection has become more efficient. Now, if this buoyancy continues in the FY25 period, and there is no reason why it should not, both of you are assuming only 1.2, but if you assume 1.4, then there is a chance for the government to spend more. As well, in the calendar 2024, we are going to have a lot of bond buying by the foreigners, some 25 billion to 30 billion. So it is a good year to issue more government bonds, isn't it? So why not go with a higher fiscal deficit? Isn't that a possibility?
So, Latha, my view is that if you want to stick to the medium-term fiscal deficit target, which is coming just another year down the road, it's better to get a good distance to that target in this year itself, especially given that it's a year where, as Devin just pointed out, we're not going to be able to have a lot of new projects or new announcements coming in Q1. So Q1 will be more modest on expenditure, and you've really got 3 quarters where the new projects will start and capex will really pick up. So it's better in my mind to actually let more of the heavy lifting on fiscal consolidation happen now rather than leave it for year 2. Year 2 is where the projects will really kick off. You know, when you announce something new, it takes time to notify that scheme, then find the beneficiaries and start rolling it out. So expenditures are always limited in year 1 of a scheme getting announced, and they pick up in year 2 and year 3. So expecting a lot of fiscal consolidation to happen at that time is not going to be very realistic.
Okay. Well, Dr. Pant, let me just put that to you. I mean, what is the possibility that they announce 5.3 or 5.4 now, but change it in the June budget? Because at that time, you come with a very big mandate. Expectation is that. And you have people willing to buy your bonds. So is there a chance that you announce 5.3 or 5.4 now, 5.2 or 5.3 now, but increase it in the June budget because of the confidence that bonds are going to be bought? Will that be taken very negatively by the market or rating agencies?
Look, what market doesn't want the surprises?
Okay.
Right. If it is 5.3 now or 5.5 now, you know, it is not that in the first quarter government is not going to do the borrowing, or bonds, G-Secs are not being sold.
Yeah.
The G-Sec pricing or the yield will respond to whatever number government announces in the vote on account or interim budget, whatever you want to term it as. So if the idea is to bring down to 5.3 or 5.4, right, might as well say it now rather than saying 5.5 now and saying 5.2 down the 3 month or 4 month down the line. Now what will happen? Both the center, both the state, entire corporate bond yields are going to respond to how the G-Sec will move.
Yeah.
So that is one risk.
Yeah. I agree with you that the government will have to have in mind, why should they pay higher interest if they are anyway going to reduce the deficit at a later point? But let's wait and see. Unfortunately, out of time, but we'll have many more discussions on what to expect. What are the assumptions with which the government will go into the budget? To wrap up on this first edition of our Budget Outlook 2024 series, Chartbusters up next.